Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas, and you want to know how you get a much cheaper interest rate than what the current market is offering? Stick around. In this video, I'm going to show you how. So the biggest challenge with buying a house in the DFW housing market is all around interest rates. You know, they're hanging somewhere, depending upon when this video drops, we'll call it 7%, maybe a little lower, maybe a little higher. It all depends. But what a lot of people are doing right now is they are waiting on interest rates to drop because their number one priority in their head is affordability and monthly payment. Well, that's not a bad thought. I don't think it's a great thought and something to necessarily hold out for. So in today's video, I'm going to show you how to get a much cheaper interest rate than what the current market offers. And I'm also going to explain the two different types of buy downs. There is what's called a temporary buy down and there's what's called a permanent buy down. We're going to go through what's the difference, what's the cost, when should I do one versus when should I do the other. So let's get into it. So interest rates work like this. There is a natural rate that is given to a consumer for what they actually qualify for. Most of the time that's based on like occupancy type of house, down payment, credit score, property type, if it's like a condo, townhome, whatever, blah, blah, blah. So who you are and what you're buying spits out this rate. It's called a par rate like golf, but I'm just saying it's a natural rate. So let's say that your natural rate right now is 7.25, okay? So we'll say, all right, well, 7.25 is too high, Brian. I don't want that. I would like it to be at least 6.5, and I want my payment, you know, lower by X amount of dollars. So lenders have access to two different components of rate. When you have a natural rate, you can get what's called a premium rate. So a premium rate is, hey, can you give me 7.99 as opposed to 7.25? And somebody would say, why in the world and why in the hell would I want a higher rate? Because with a premium rate, you get money back. So this is designed for people that say, hey, I only have $15,000 in the bank. I've got to do a down payment. My down payment plus the closing costs are 15 grand. I don't want to eat up all my money. So what I will do is I'll have Brian, instead of giving me a natural rate, he'll give me a premium rate. And I say, Brian, I need 5,000 bucks at closing. So instead of coming with 15, I come with 10. I'll say, cool, let's move that 7.25 to 7.99. Yeah, the payment will be higher by 100 bucks, 200 bucks, whatever it is, but we'll kick you a $5,000 credit. So that way, instead of coming to the table with 15 grand, you come to the table with 10, save yourself 5K, okay? So that's what a premium rate is. We're gonna go the opposite way now on lowering rates, which is called discounted rates. So there are two versions of lower rates. Discounted rates, which is where you hear discount points, which is where you hear like online discount fees. So when making your interest rate lower than what you actually qualify for from the natural rate, you would like to buy down the interest rate. The way you buy down the interest rate is you buy points. You can buy little points, a lot of points, and obviously the more points that are bought, the further down the rate goes. Now, you can also do this two ways. Buy down the interest rate temporarily, buy down the interest rate permanently, okay? So these are the most two popular things that people are doing right now to try to say, hey, what can I do to get my monthly payment lower? Most of the time, not a whole lot when it comes to like lowering the price of the house or putting a little bit more money down. It just doesn't move the needle. The way to really get the payment where people want it is to take that natural rate and buy it down to 1 or 2 or 3% lower than what it actually is. So the kicker is, if you do it temporarily, it's a lot less expensive. Example, numbers. I'm going to use a $500,000 loan. Everything I speak on is loan amounts, not price of house, because this is how we run our calculations. So if you have a $600,000 house and somebody puts $100,000 down, their loan amount with me is 500 grand. So I'm going to use 500 grand as an example for now. So let's say they have a $500,000 loan amount. Their natural rate is 7.25. They say, hey, Brian, I want to do a temporary buy down, which means I only want to buy the interest rate down for a short period of time. That short period of time can be 1 year, 2 years, or 3 years, and it can be 1%, 2%, or 3%. So if you do a temporary buy down, the way to calculate the math is really probably 1, 2, and 3% of the loan amount. Now, it's not exactly apples to apples, but it's close. Meaning if you have a $500,000 loan amount and your interest rate is 7.25%, and you want to buy that interest rate down for 1 year, 1% lower, so it'd move it from 7.25% to 6.25%, it would be 1% of the loan amount. So if you have a $500,000 loan and you want to buy it down temporarily, 1%, it would be 1% as a fee off the $500,000, so it'd be $5,000. If you wanted to buy it down 2% from 7.25% to 5.25% for 2 years, year 1 and 2, it'd be about $10,000. Now it's actually a little bit more than 2%, but it's easy math. And if you wanted to do the same thing, which is, hey, I want to get this thing from 7.25% to 4.25%, buy it down 3% starting on year 1, and then 2 and 1, it would be about 3% of the cost of the loan. Call it $15,000. Now, it's a little bit more than that, but simple math if you're out there in the street. Really, it'd be about $5,000 for a 1 year and a 1%. It'd be about $12,000 for a 2 year, 2%. It would be about $17,000 to $18,000 on the 3. But easy math for dumb people like me, just figure out exactly where you want to be, take 1% of the loan amount, and then obviously that's how much you would need to pay in fees. So the question is, all right, well, Brian, why would I want to do it temporary? And I, as the buyer, really don't want to pay $10,000 to lower that interest rate. So let's talk about that. So temporary buy downs are 30-year mortgages. You're just teasing the rate down for 1%, 2%, or 3% for year 1, 2, and 3, depending upon what you want to do. Now, if you tease it down 2% for 2 years, if you don't do anything after that, it just goes back to the natural rate of 7.25%. So a lot of people get this confused with ARMs. It's not an adjustable rate. It's just a temporary buy down for a short period of time. And if you don't do anything, which I will make sure you do something, because obviously I'll follow up with you to refinance, but it would just go back to the 7.25% rate and stay there for the rest of the life of the loan. There's really only one reason that people do temporary buy downs: to get their interest rate and their payments in line with their goals short term for the next year or 2, so their payments are much cheaper until the natural interest rate market starts to come down. So we all know we're in that 7%, 7.5% range. We all believe, including me, that maybe by Christmas 25, rates are probably going to get down somewhere, I think, safely in the 5s. Now, is that going to be 5.25 or 5.99? I don't know. But I think saying somewhere in between 5.5 and 5.99 is probably safe. So you don't need a long period of time to keep your interest rate lower and keep the payments lower, because as soon as we get to that place to where rates are permanently in the 5s again, everyone's going to refinance off of these 7.25% temporary buy downs and say, hey, I want that 5.5 so I can get the savings, and I want that rate forever. So the temporary is designed to be a short-term, cheaper solution for a consumer that doesn't need 4.25%, 5.25% forever. They just need it for a short period of time until the market interest rates start to come back down, and they can go refinance and get that on their new loan for the life of the loan, and it saves them a lot of money. Second piece about a temporary buy down: the cost that it takes to get the interest rate down 1%, 2%, or 3%, I'm just going to say cannot for now, but should not ever be paid for by the buyer. So the concept behind this is, if you're out in the market and you and your agent are shopping and you find a $600,000 house and the seller will take $580,000 for it, conceptually it's don't take the $20,000 off the price. Why? Well, you're still going to have the 7.25% rate. You're just going to be, buying it at $580,000 versus $600,000, and $20,000 over 30 years, it doesn't move the needle at all on the payment for you as the consumer. It's not what I call the highest and best use of the concession. If the seller says, yes, we'll give it to you for $580,000, they don't care where you use the 20. I do, okay? So my strategy would be give them the $600,000, but just ask for the $20,000 as a closing cost credit, and then you can take that $20,000 and buy down that interest rate at their expense for 2 or 3 years, 2 or 3% lower. So you've got really, really cheap payments for a long period of time until the rates come down, and then you can refinance and get yourself a permanent fixed rate for a longer period of time. Also, bonus bucks, if it cost you $20,000 to buy this interest rate down for 2 or 3 years, but let's say, hey, Brian, I end up refinancing Christmas the following year and I had 24 payments and I only used 17 payments. Any of the unused money on that temporary buy down goes back to you as the consumer as a refund. So that money will get credited towards your principal balance, and most of the time, whatever the surplus is that's left will pay for your refinance fees the next time around. So it literally costs you little or no money. okay? That's part one, so that's a temporary buy down. These are rare. They only are utilized and used in markets where people are just waiting on interest rates to come down. We all know it's right around the corner, not years, probably months, anywhere from months to maybe a year and a half, but the temporary is cheaper, it's faster, and it's short term. Second piece is you can do what's called a permanent buy down. So we talked about buying these down 1, 2, 3 years short term, somebody else's expense just to get us where we need to be until the market gets good. So let's talk about a permanent buy down. So if you have that 7.25 natural rate, let's fast forward in time 2 years from now. Let's say interest rates are at 5.99, people are refinancing left and right, there's a refi boom, people are going nuts. So let's say somebody wanted to refi and now the market gives them a natural rate of 5.99. Well, they might say 5.99 is great, but what I'd really like, Brian, is I'd like to move that interest rate from 5.99 down to 4.99. I want it to be permanent, and I want it to start from payment one all the way through the life of the loan, because obviously it's going to save them a ton of money. At that point in time, you could elect to do a permanent buy down, which is because it's a refinance and because it's your house and you're using the equity, you could spend probably $10,000, okay? So remember, the temporary buy downs are cheaper. Earlier I said it's like 1% off the loan amount, 2%, whatever. In this scenario, if you bought it down permanently from 5.99 to 4.99 and you had a $500,000 loan, it'd probably cost you 10 grand. So it's much more expensive, but you're gonna do it one time, you're gonna make a deep cut, you're gonna have a really aggressive and low rate, and as long as you're gonna be in that house for a long period of time, it makes sense to buy down the interest rate. Now, what I don't want clients doing is spending $10,000 to buy down the rate from 5.99 to 4.99. It may save them $400 a month on the payment, but they know that they're gonna be moving out of that house in 15 months. And I'm like, well, don't do that. You're wasting equity. So when I get into these strategies with clients, I also do what's called a break-even point of, hey, if you spend $10,000 to buy down the interest rate from 5.99 to 4.99, it saves you $500 a month. You have to say, how many months will it take me to get the 10,000 back? And if it takes 25 months, I say, hey, are you for sure going to be in this house and be making payments on this house for 25 months or longer? If the answer is yes, do it. If the answer is no, don't, because you'll waste the money, you never get the equity back. Sometimes it's like, well, I'm only gonna be here for, 18 months. So instead of buying it down from 5.99 to 4.99, you could buy it down from 5.99 to 5.5. So that may cost you five grand, but you may be able to get all that back within 12 months. So there is a component and a break-even strategy here to make sure not only can you buy it down permanently for a longer period of time from payment one, you have to make sure that you're going to be in that property for a long time and break even. You would rarely ever do a permanent buy down on this side, because rates are so high, it would cost so much money to get it from 7.25 down to 4.99. It would just be like 80 grand. And so what happens is that most people don't buy it down permanently because they're like, one, it's too expensive, but two, the interest rate market is gonna give itself back to the consumer, hopefully up to 2% over the next 24 months. So let it come back for free so you don't have to pay for all of that. And then when it gets to a bottom, if you decide that you wanna take that natural rate 2 years in the future, take it down 1.5%, whatever you want. We'll go through the numbers, do a permanent buy down, because you're probably never gonna refinance again. And as long as you understand the cost to do it, the savings in the payment, and the break-even point, it is a great idea to potentially do a permanent buy down as long as you know the numbers. So, two components of interest rates: natural rate, premium rate, discounted rate. That splits into temporary, short-term, maybe 1, 2, or 3 years, 2 or 3%, just to hold the payments low until the market drops. And then you get over here, which is, hey, let's let rates get as low as they can. If I like them here, don't touch it. If you want to get it lower, you can buy it down even more from your own expense. It's a little more expensive, it's permanent, but as long as you know you're gonna make the payments on it and stay there for a long period of time, you may end up winning the long game, because obviously it's gonna save you a whole lot of money in interest during the life of the loan. So listen, I hope you found this interest rate video useful. If you did, do me a favor, like, comment, subscribe, even share with somebody that you know that can benefit from this information. If you're interested in getting a pre-approval, talking about buying a house, or just want to have a conversation around mortgage term strategies, the state of the DFW housing market heading into 24 and 25, reach out to us, email us, call us, text us. We're always here for you. Until next time, stay tuned.